Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy.
David, thank you so much for joining the What the Finance podcast. I really appreciate you joining today and talking with me. I'll go on to my first question, and it's pretty interesting. It's like a key message I've seen with a lot of the stuff you release, and when I've been researching you, is sort of generational wealth. So, how do you define generational wealth, and sort of why should people be striving for it?
Well, I'll start with the last part of the question and work my way to the front. The reason why we should be striving to it is because inflation will keep you in a form of poverty if you don't have assets that accumulate yield and appreciation. And I can go into detail about what I mean by that yield and appreciation. So that's why inflation is the silent killer. And then why should we strive to have generational wealth is because the whole point of life is seeking larger expression, right? When we talk about trying to be better as people, and we're talking about things growing, right? It's always about outgrowing your present environment or your present economic status. We all seek to have more, and that's a human nature. So if we choose to do that, then it must be done in a consistent way, and it must be done generationally. So generational wealth, right, is what's going to allow us, our children, our children's children, to always have the ability to seek larger expression, whether that be in having money, in physical joy, in health. So generational wealth doesn't have to just be attached to money, right? Wealth is multidimensional. So yeah.
Yeah, it's really interesting. So rather than having, the short-term goals, it's really extending it out, isn't it? And as you said,
Yeah.
generations, hundreds of years potentially.
Yeah, because I think a lot of times when we fail, it's just that we're not asking for enough. You know what I mean? Or when we don't have what we want, we just didn't ask for enough. So I think we need to think bigger. And I think if we think bigger, we actually may get to the goals we really want. Because sometimes we're thinking too small. We're thinking just to pay a bill, right? When we need to be thinking a little bit bigger than that.
Yeah, definitely. You see so many people, we know it's quite a problem that just live week to week, as you said, wage to
Yeah.
wage, and they're not looking further
hmm
than what's literally ahead of the next day or next week.
I agree 100%. And when our goal is just to make it build a bill, we're gonna fail at that. But if we actually made our goal to build assets for myself and my children, well, actually, we may find that that is actually where the success is, and that is where we find the triumphs, right? And it's funny because you would tell people that, and they'll think like, no, it's the small me may paying bills and bills. Like, no, actually, no, not really. So I know it sounds weird probably to the common person, but it actually does a lot, especially to the mental.
Yeah, definitely. I agree. And do you want to you mentioned something quite interesting to start with, where you said obviously inflation is, and we're seeing it at the moment. It's obviously, we're seeing, I think it's what was it? 5% CPI or something ridiculous like
Yeah, it
that.
was
So
crazy.
it's almost worse now than it has ever been before, or last
Correct.
40 years.
Yeah. So hedging inflation is really important, right? And back in the day, right, gold was in real estate were the ways to hedge inflation. But now we have this cool thing, right? Cryptocurrency. That's about that is another form of hedging inflation. But yeah, it's really important, and I'll go into what I said earlier about yield and appreciation, right? I think it's really important for the common person to understand that. What I mean by yield and appreciation is if I have a stock that I hold and the stock goes from $1 to $2, that's what we call depreciation. Now, the dividend that I would get from owning that stock is what we consider yield, is cash, right? So it's a combination of yield and appreciation gives the best assets. Some assets only give one. For example, if you're an options trader, you only have appreciation, and that appreciation can only be realized once you sell. Right? There is no dividend from the option contract. That's not a thing. There is no yield. You have real estate, right? You have equity in the house that hopefully goes up over time, appreciation. And if you're renting it out, you're getting a yield, right? So and we can go across many different types of investing, but all investing, you should try to get appreciation and yield. And if you don't have both, you should have an exponentially large amount of one. For example, options has a great appreciation. That stands for that. So, and even crypto, right? Appreciation. Though certain cryptos, right? If you stake Cardano, you actually can get yield off of it. But that's a totally another conversation for another day.
Yeah, no, that's really interesting. Well, do you want to maybe talk a bit more about your journey now into finance and trading? Because your ideas are pretty interesting. So sort of where did you learn this and how did you get started?
Yeah, about 5 years ago, I really knew that I had to make a shift. Prior to what I do now, my career was in sports and athletics. I worked in physical therapy for 3 years. After working in physical therapy for 3 years, I changed scopes within the field of sports. So I became a strength and conditioning coach, and I was director of strength and performance at a private Christian institute for 3 years as well. So I was prior to this, I was in sports for the last 6 years, but I knew that I didn't want to have to sweat and exchange time for my dollars because I knew there's a huge ceiling for that. And I knew that, well, I needed something that can work while I couldn't work. And I was like, well, my dollars can. My dollars can be my employees. And then from there, I seek larger expression. I seek more knowledge. I wanted to build my intellectual property. So I surrounded myself with people who can help me do that. Coincidentally, I had a family member, my cousin, who was a financial analyst, and he kind of took me underneath his wing and taught me macroeconomics before I even learned about stocks. So I have a very good understanding of inflation, bonds, and economic indicators such as unemployment, and I'm able to have a good lay of the land from an economic standpoint. And if you understand macroeconomics, microeconomics, such as breaking down companies, is really easy actually. I just kept enhancing my ability to do that, training my eyes to learn technical analysis. And then the last big jump was me becoming a great futures trader, which is how I'm able to fund my personal life. And then after that, it was just becoming very knowledgeable and absorbent in terms of technology that's taking over the world, such as cryptocurrency, the semiconductor industry, things of that sort. So kind of just allowing myself to become a student of investing and making myself multi-dimensional so that I'm able to be an asset to people who meet me, and also I'm able to impact the communities in which who don't have access or know about how to build generational wealth.
Yeah, and that's one thing I've noticed. You can it's so much to learn in finance and trading. You can keep learning and learning, and everyone has their own. Even if they're not as experienced as you, they might just have that one piece of knowledge that you've never heard of. And that's what I love
exactly.
about it.
And it takes you a long way, that one piece of knowledge.
Yeah, exactly. Yeah. So you mentioned futures trading there. It was sort of, why did you choose that over other derivatives, options or other things, or just other assets?
Because the appreciation was a lot. It was exponential, right? What I can make in 20 minutes trading futures, I would probably have to make probably in like a week or a month doing options. And also I'll need a lot more money capital for options as opposed to futures. So it takes less capital. And if you're good, you have a higher appreciation, and the gains are realized instantaneously.
That's interesting.
So that was the reason. So I trade the bond market. I don't trade the S&P 500. I don't trade the Dow or gold. I trade the bond market. The reason that is because, contrary to what people know, the bond market is the biggest market in the world. There's a $40 trillion market, which is a lot bigger than the stock market. So I trade the bond market, and I trade 3 times a week. I make my money very easily. I live way below my means, so the money I make trading is more than enough to cover my living. And then I have a consultant business and a nonprofit that I run as well, where I do my philanthropy.
Yeah, awesome. That's interesting. And what type of bonds do you trade? Is it just US Treasuries, or is it all company?
Yeah, I just trade the US 30-year Treasury bond, which is ZB.
Okay, awesome. And why is that? Is that just you find there's more opportunity there, or?
Yeah, the amount of money I can make. So in the futures market, you have like you would say, oh, a stock went up $1. In the futures market, you say, oh, I got a tick. A tick is basically 1 cent, essentially. So the tick size for the S&P 500 is $12.50. So if I get 1 tick, I get $12.50. For the bond market, it's actually $31.25. So for 1 tick, I get almost 3 times the amount. So that's why I love the bond market more. It pays more money. So yeah, and it's easier to trade too because the assets move slower than the S&P 500. The bond market moves a lot slower compared to the stock market.
Yeah, it's interesting. I know as well, futures, you can obviously push up the leverage as well, so you can actually have
yeah. Yeah, you get high. Yeah, exactly. So, but that's where your risk management has to come in play, right? So then we're not over leveraging because you can actually owe money if you're on the bad end of a trade. So
Yeah.
yeah.
Yeah, definitely. So I don't know if you can give us sort of the special sauce, but what's your strategy for trading bonds?
I'll give you a tidbit. This
Okay.
is for futures traders. This is for my futures traders. The key is a high contract size, a low tick value. A lot of people do the opposite. They try to do a low contract size and get a lot of ticks.
Yeah.
Yeah. The key is a high contract amount. For example, use myself. I trade 10 contracts on the ZB, right? And I try to get 3 to 4 ticks a trade.
Which is hard. As you said, it's 4 cents or something.
Yeah, which is basically 4 cents, but each of those ticks are worth 31.25.
Yeah.
And I trade 10 contracts. So you guys do that math, you'll basically be able to figure out how much I made per trade.
Yeah, that's interesting. And it's the same thing with stocks and shares and everything. If you trade more shares, obviously you don't need it to change as much.
Exactly. Yeah. And so that's it's a very simple concept, but it goes a long way if you keep it consistent. And same thing with options. Well, actually, options, more contracts, the more money you can make. So same thing though, right? More contracts, more money you can make, as opposed to having a small amount of contracts and trying to shoot for an astronomical strike price that may or may not hit.
Yeah, definitely. And what would you say are the greatest lessons the market have taught you?
The greatest lessons the market has taught me is that the market doesn't owe me anything, number one. So revenge trading or revenge investing is the worst thing to do. And it's definitely taught me patience and discipline. You need all three of those things, and it really makes you a great trader, an investor. And there's a difference between trading and investing. That's important to throw out too. They're not one and the same. But those big lessons the market's taught me. Don't revenge trade. The market doesn't owe me anything. Patience and discipline.
Yeah, I think we've all had that mistake of revenge trading, and then you're just like, oh,
yeah,
and you shouldn't do it.
Yeah, I've lost, which isn't a lot, probably the grand. I've lost 5 figures in like 30 minutes.
Yeah.
It's gut wrenching.
Yeah, and especially when you do it the first time, or when you're like, oh, and you're not meant to do it, and you do it, and I think it's just the lessons that you have to have on that journey, though, isn't it?
Yeah, I tell people the reason why I was able to get to this place because I really messed up a lot, but I just didn't give up. I just refused. I was just like, I'm just gonna learn how to do it better, and and guess what? I ended up messing up again, but I just told myself, I'm just gonna keep trying to do it better, and eventually you get to a spot to where you know everything not to do. So guess what's left? What to do. So it's really funny.
Yeah, and it's like understanding. And I've talked to someone before, they were like a psychologist, and they talk about psychology of trading, and it's like understanding yourself and the mistakes you're going to make, why you make them, and trying to avoid that.
Yeah, so to my traders, I think that's a key tip that traders can take, right? The more you know yourself, actually, the better trader you can be. So for example, like when I trade, I log all my trades and my emotions during the trade. So it's almost like a playbook for me. I'm able to go back and see what my emotions were when I lost and figure out a strategy to mitigate that. And I know what my emotions were when I won. So my goal is to try to always be in that place. And then now, right, you allow yourself to become a better trader, and you're more emotional. You're more actually less emotional about your trades because you understand what you're feeling, as opposed to not understanding your feelings take over what you do.
Yeah, definitely. If you have that system where you write it down, then you can look at it and you're like, hang on, this is, I shouldn't take this trade.
Yeah, you got to be a little robotic when you're trading because the emotions will actually get the best of you.
Yeah, interesting. So are you mainly a day trader then, obviously? So very, very.
Yeah, I'm a day trader and I'm a long-term investor. I would say I'm more of a long-term investor than a day trader. I understand the benefits of both, because one gives me only appreciation, the other gives me yield and appreciation. So it's the combination of the both.
Yeah, I guess that's great. So you'd say if someone's putting together a portfolio, or they're trying to, put together, basically their portfolio, it's having a combination of both.
Yield, and you want a combination of yield and appreciation, correct? Across multiple assets. So right now we're talking diversification.
Yeah, definitely. Awesome. So you sort of mentioned that you're you love macro and you know quite a lot in terms of the macro environment. So are there any sort of key catalysts that you're watching in the markets at the moment that you think could have a big effect on bonds or anything else?
Yeah, actually, I put out a tweet yesterday. So we have the infrastructure bill, we have the reversal in crypto, we have inflation, and we have the S&P and the indexes all at all-time highs, all diverging factors, right? We will say the infrastructure bill is something as a bullish sentiment or a bullish catalyst. We have the reversal in the crypto market, which is a bullish catalyst. We have the S&P 500 at all-time highs, which is a bear catalyst, right? Because we know we're due for a correction or a pullback. Fun fact, September is always a harsh pullback. Either and a correction is 5 to 10%. Anything 15 to 20 is considered a crash, I believe. No, I think 20 to 30 is considered a crash. Yeah, don't fact check me on those numbers. And then what was the other thing I said? Forgot there was one more, but those are the major and inflation. Yes, of course, inflation. Those are the major catalysts that I'm seeing, and I'm seeing a lot of divergence. So with that said, recently I tweeted out that like I actually took profit on a lot of my long-term investments, and I'm actually just sitting on the side with cash because, contrary to popular belief, cash is a great hedge.
You think so? Because a lot of people are, you look at Ray Dalio and he's saying
cash is trash. Yeah, I know. But cash is trash, but it's a good hedge. The reason why I say that, because think about it. He has a point. Hoarding dollars and saving dollars is trash because inflation is going to eat away at that. Remember, I'm talking about putting my cash to the side to re-enter and invest. So there's a little bit of difference there. They're not. He wouldn't consider what I'm saying. He wouldn't consider what I'm doing trash. He would consider it probably strategic in a sense, right? I'm just pulling my profits and waiting to buy $100 house at 50,000, right? So that's all. I'm waiting for the market to correct to get further long-term entries because I didn't sell all my long-term positions, but to get further long-term entries at a greater discount. So yeah.
Yeah, it's interesting. So as you said, you're taking, some profit, mate, because obviously it's gone up quite a lot, and then you're expecting potentially that there may be a pullback, even if it's 10. I think what you said is correct. 5 to 10% it can happen just off nothing,
and
whereas
that's
25 to 30 is more of that's sort of like a recession or something like that.
Correct, exactly. And this kind of been the year of the indexes. If you trace the rate of return on the indexes, the S&P 500, the Dow, and the Nasdaq, is actually higher than most of the companies within those indexes. So it's been a year. The indexes have really done well. So if you've been trading SPX, SPY, DIA, QQQ, right? You're loving it because they have been running, especially if you've just been holding them long term. It's the companies that are actually lagging behind the indexes. So I find that interesting.
Yeah, and I guess you could say it's, if you look at the S&P, it's obviously, the top 4 companies have 20% of the market.
Yeah, I think Tesla, Apple, Microsoft, and Amazon, right?
Yeah, I think, and Google, I think, is in there as well. Yeah, which is crazy. And then I was sort of looking at the chart the other day, and it just keeps bouncing off like the daily 50 EMA. There's like that,
keeps bouncing off the 50 days. Yeah. Now I think when we break that 50 days, we're going to see because I looked at it yesterday too. From the all-time high to the 50 days, only a 4% correction. But if you do it from the all-time high to the 200-day moving average, that is almost a 12% correction. I think we're going to be in that 8 to 10 range, which is healthy, which is very healthy, by the way. I would love it because we don't want the bull cycle to extend too long. We want a healthy pullback to continue the uptrend. It's just going to be a higher low in the grand scheme of things, right? Higher low, we're going to create what? A higher high. So it's all good.
Yeah, definitely. And as they say, it's the faster it goes up, the faster it comes down. So you want it to take a bit of time.
Yeah. That's another thing, right? Stocks take the stairs up and the elevator down.
Oh, I love it. Hey, and it's so true. You look at what happened, the COVID-19 crash.
March, yeah.
Oh man, that was crazy. And I remember watching, just kept hitting circuit breaker after circuit breaker, and it's true.
Yeah, they even had to shut down the market, like you're saying, at certain points, so people can slow down the decline. Yeah, but in the grand scheme of things, right, that was probably the biggest opportunities because look at the bull run we've gone on since then. So again, when people listening, corrections and crashes are healthy opportunities. Though it may suck in the short term, think 5 years out, or this was the shortest recession ever, apparently, what we went through in March. So those are just buying opportunities, which is why I say when investing, cash is a hedge when investing.
Yeah, definitely. And that's the same thing. You got to be unemotional, especially when these things happen. Have a plan, be unemotional, when everyone else is
Yeah. Yeah,
fearful.
that's why you got to make sure you have good fundamental analysis and you're investing in the great companies, because you're just seeing that a great company's at a discount. There's a difference between a damaged stock and a damaged chart and a damaged company. Those are not one and the same.
That's interesting. I haven't heard that. So you'd say, obviously, if the chart's very bearish, but the company has good fundamentals behind it, it has good cash
Correct.
flow, you'd still be
Yeah,
confident
that's a
in it.
great opportunity. For example, Apple was flat since last year, September. We've just recently see a run up, right? That chart isn't the greatest. It wasn't looking the greatest, but as we know, Apple almost has $1 trillion market cap. It does have $1 trillion market cap. It has more money in cash than most countries have.
Yeah.
So again, yeah, right. A chart that's maybe bearish but has great fundamentals is just a great house at a discount if you're looking at it from that metaphor. Now, if you have a bad company with a good chart, well, that's a number one, that's a red flag. Number two, if you have a bad company with a bad chart, well, that makes sense. It's a bad company.
Yeah, definitely. And even if I guess, as long as they're growing, like you look at Tesla, they might not be, they might be extremely overvalued, but they're growing, their profits are growing, the revenue is growing.
Correct.
So
And all tech companies are overvalued technically. So like you would never look at PE ratio for a tech company because they're all going to be over 15 or 20, right? So you got to have other metrics to evaluate it by to get a good idea. And also innovation is a big aspect, right? Like I said, thinking long term, the next 5 to 10 years, right? What's Tesla going to do? Because if you read their 10K, they don't just sell cars, people. They don't just sell cars.
Yeah, they're a software company as well, which is, if you think of the subscriptions. So you obviously mentioned tech there. Sort of what other industries do you think will have the greatest opportunities sort of over the coming 5-10 years?
Semiconductor industry, 100%.
Yeah.
Semiconductor industry and growth outside of Moore's law. So for those who don't know, Moore's law is the law that says every 12 to 24 months, chips, the nanometer goes down by 2. So we've gone from 7 nanometer to 5 nanometer. Next will be the 3 nanometer chip. And basically that increases the processing power in which these little chips works within our computers, laptops. And that's great because we know artificial intelligence is a huge part of the technology. So that's going to allow for faster AI and more self-learning for these AI algorithms. So I'm really big into the semiconductor industry, of course, the EV space. And I don't want to say EV in terms of the car, but I love the supply chain of EV. So we're talking like lithium as an element being used for the lithium batteries. So I'm really bullish on lithium as a supply chain in terms of how a car is made. So those are industries I'm really looking into. And the most recent one I've been talking about a lot is water. Water is traded as a commodity now, for those who do not know. So that's a huge industry that is coming up. I actually plan on doing a webinar next month called The Diffusion of Industrialization. Is going to be the infusion of technology in the industrial sector, because that's going to be a huge wave of innovation. And this infrastructure bill goes place, right? Basically, these companies that have access to free money to build out this infrastructure and allow technology to be integrated into industrials. For example, with all these pipes that we have for water, well, if we had forms of technology that can better monitor it for us so that we can get ahead of spills and things of that sort, or breaks in pipes, like that's not a part of the infrastructure right now that we have in the industrial, right? When we have AI algorithms, having sprinkler systems go on and off, right, as opposed to timers, right? We can better utilize resources such as water. So that's a huge, remember, any great company comes from a problem being solved. We have a water problem globally, fun fact. So the emergence of technology fused with that creates an opportunity for money to be made.
Yeah, that's super interesting. So I guess one thing as well, as you said, the more these semiconductors can process, the more affordable it is to put them in a lot of these things that may have not been affordable in the past.
Right, exactly. Yeah, exactly. Because you can make them for the same price, but they work just as well. So that's the cool thing about Moore's law. But also think about this too, right? Currently at the 5 nanometer chip, according to Moore's law, in 4 years we'll be at 1 nanometer. Growth outside of Moore's law is what I'm also bullish on when it comes to the semiconductor industry, because you have to ask yourself, well, what happens when we can't go past the 1 nanometer chip because it defies the physics of the law of physics. So that's interesting too. Again, disruption innovation provides opportunity.
Yeah, interesting. So what do you think happens when we can't progress past that?
Out of Moore's law, it's going to be specialized chips. It's going to be and hybridized chips. That's going to be growth outside of Moore's law. AMD actually is already ahead of that curve. They're stacking chips, and they call them 3D chiplets. You can Google it. Lisa Su actually revealed it at the last major event that they did. So that's what growth outside of Moore's law is going to be looking like: specialized chips and hybridized chips.
Yeah, interesting. And I think I saw something about that with Tesla as well. They're not using semiconductors. They're like, I don't know if it's microchips or something else, but they're actually using software. So it's still acting like semiconductors because obviously.
Yeah, exactly. Yeah. And guess who they're partnering with for that? AMD.
Yeah.
Fun fact.
That's interesting. So you see AMD as a major beneficiary and potentially.
They've been stealing market share from Intel for the last 2 to 3 years. When they had an issue coming out with the 7-nanometer chip, right before the shutdown in March of last year, AMD has been slowly but steadily stealing market share from Intel. I believe AMD will be and Nvidia would be the big juggernauts within the semiconductor industry from a manufacturing standpoint.
Yeah, awesome.
Because they're a fabless company. They don't. I'm sorry. Not from a manufacturing standpoint. They're a fabless company. Nvidia, AMD are fabless companies. I mean, they don't make their chips. They actually outsource to Taiwan Semiconductor that actually makes the chips for them, and then they just provide. Distribute them through end devices.
Yeah, and I think the key thing what we're seeing at the moment, obviously, there's a shortage of these semiconductors, but once it increases in the production, there'll be an oversupply. What's the difference?
Yeah.
They're all going to be the same. So how do these? Once they get sent to Nvidia or AMD, then they actually change it to their own, be it through their software or be it through their
correct system. Yeah, exactly. And that's a good point, right? We are going through a chip shortage right now. That's because of the supply chain issue, right? And the supply issue is twofold. From a material standpoint, it's the silicon, because it's the same silicon we need to make the vials for the vaccine. And then also the manufacturing, right? Taiwan Semiconductor can only create so many chips for all the partners that they have, which is why the U.S. is trying to look to Intel to build the foundry, right, to help the U.S. with the global chip storage. But the issue is, it takes about 4 years to build a foundry.
Yeah.
Remember, I told you in 4 years, you'll already be at the 1-nanometer chip. So think about it. It doesn't really work out very well to build a U.S. foundry. It's kind of too late.
Yeah, definitely. And that's a lot of the other shortages. You mentioned lithium. It's a similar thing. Like if the demand increases, it takes, potentially 4, 5, 10 years to build another mine. Same with copper. So it's one of these things, as you said, it's looking further in the distance at these industries that are further down the supply chain, but they're still going to benefit from it.
Yeah, but exactly, because remember, when there's a limited supply and high demand, price goes what?
Yeah, definitely. No, that's super interesting. So obviously those are the industries you're looking at. What would then be your process for sort of analyzing the specific stocks that you would want to invest in?
Okay. So I'm a really big ETF guy. So I love ETFs, exchange traded funds. Think of them as like an all-star team of stocks. But my process is to find a industry. And once I find that industry, see what the innovation is, because that's what's going to let me know the 5 to 10 year trajectory. After that, I'm looking at the previous 5 to 10 years to see, do they have a competitive advantage that allows them to be relevant? For example, Apple has the strongest ecosystem in the world, because I'm sure many of us have an iPhone, probably have a Mac, probably have a tablet, probably have an Apple Watch. It has a strong ecosystem. You probably have an Apple TV, right? And then when they start adding their things to cars, then we're going to have a huger ecosystem. So those are the things I'm looking at. After that, I'm looking at fundamentals to confirm my sentiment, right? Gross profit margins, asset over liabilities, research and development, SGA. I'm going all 3 financial statements: income statement, balance sheet, and cash flow. I'm looking at all 3. After that, I'm looking at the chart to find the entry. I tell people, keep it easy. If you have a great company, you can buy it around the 200-day moving average, you're good. Yeah. Keeping it super simple. I just gave you guys a cheater's code. That's the cheater's code. I mean, if you can find the ETF, such as XLK that has Apple and Microsoft in it, even better.
Yeah, awesome, definitely. And I think that's the thing. It's like, especially in the bull market, if it's down around the 200 EMA, just buy it. Like,
Yeah,
yeah,
literally.
daily.
Look what happened. Go look at Apple, Amazon, Tesla. Look what happens every time they come to buy the 200-day moving average. They do one thing and does not go down. I promise you.
Yeah, definitely. And it's just having that patience, isn't it? And like having that, you know, as you said, the psychology and just understanding, okay, just buy it here, you know, maybe have a plan if you have a stop loss or if it's for the long term. Like at the end of the day, it's
Mhm.
probably going to go up over the long term.
Correct, exactly. That's why I say if you play long term, and also long term is the easiest way to invest. You don't have to be in front of your computer all day,
Yeah.
right? It's literally the easiest way. So guess what? You get to live your life and you get to have all that yield and appreciation without having to do all that work. That's the whole reason why I wanted to get out of the career I was in. I didn't want to have to exchange my time for dollars because you're in front of the computer. You're exchanging your time for a dollar, right? And I also wanted to not have to sweat for all my dollars. You're working less. So literally, that's the cheater's code. Invest long term, do your due diligence, and execute.
Yeah, definitely. It's better. It's definitely better for the soul as well. Not looking at the computer and, you know, stressing all the time, waking
Yes,
up
it
in
is
the
a
middle of
lot
the
better.
night.
100%.
Awesome, man. So I'm guessing you're probably more of a growth stock guy then rather than compared to value stocks.
Yeah. 100%. You hit the nail right on the head. I'm a growth stock guy because value stocks, hence their name, right? Value stocks do have a place because usually value stocks give you a lot of yield, right? They have a great dividend, such as Coca-Cola, McDonald's. But a lot of these value companies, such as like airline companies, they hit a ceiling. There's no growth outside of them. And also, their financials are looking horrible right now.
Yeah.
They're super over leveraged. Due to their debt to equity ratio, look at how much they're being bailed out. You don't want to put your money there. Also, like, yeah, they may pay a great dividend, but like that's a dividend trap, right? Just because a company has a great dividend, but the company's been trending down for the last 3 to 5 years, that's a dividend trap. Because guess what? They can at any point say, you know what, we don't want to pay a dividend, or we're decreasing that dividend. Now you got X amount of shares that you're holding on a depreciating asset, right? That's not paying you as much yield anymore. Now you're just stuck, right? That's not good investing. So I am a growth guy, and I think all people who are young and even old should have a higher percentage of growth as opposed to value, because you want your money to grow. And if it's a great company, right, it's going to maintain that growth. So the up and down in terms of volatility won't be as much.
Yeah, awesome. That's a really good thing. I agree as well. I think definitely growth is the way to go. And, you know, if you look at a lot of the big companies as well, they're the ones that are the most profitable, they're making the most money, and they still, some of them, you know, Microsoft pays a small dividend as well. So why wouldn't you
Yeah,
own them?
exactly. And Microsoft is considered a growth company, but they're probably one of the most stable companies if you look at the chart. So
Yeah.
like, you know, that's why I'm saying, like, I know people hear growth and think volatility, but you'd be surprised the great companies don't have as much up and down volatility as you think they would. They're
Yeah.
actually the safer place because we know that's where the world is going to go. And we know that if the Fed is going to bail anybody out, it's going to be these huge conglomerates such as Google, Microsoft, Apple, because they run the world. If you think about it, it behooves you to put your money there.
Yeah, they definitely do. And I guess worst comes to worst, they'll be split up and then you'll probably make more money at the end anyway.
Exactly.
It's a great way to think about it. So obviously you've got the Cardano hat on, so you're a mad crypto fan. Yeah, represents ADA. So sort of when you look at crypto, how do you treat it differently to sort of equities and other assets?
Yeah. So the way I look at cryptos are like I really make I'd always, the way you should look at them, not the way I should, the way I believe you should look at them is, of course, they're an asset, but you need to look to see which ones are solving a problem. The greatest companies in the world, the greatest inventions solve a problem. So ask yourself, the crypto that I may like, what problem does it solve? And then can I verify it? For example, the companies you heard me say 10K, I can look at a company's 10K, which is an annual report, and look at their financials. Look at what risk they have, because they literally have risk factors labeled. I can look at their business model. I can see what money's coming from where. For cryptos, they have something called white papers. You can look up a white paper for a crypto and find out what it does. You can go to the website and find out the genesis and where it's going. So once you are able to identify the asset and see that it solves a problem, and you can verify it solves a problem, well, at that point, you just want to find a great entry, right? But the hardest part with those first two, for example, what problem does Bitcoin solve? Well, it's a store of value, very similar to gold, which hence the name, digital gold. Ethereum, customized transactions, aka smart contracts, right? Cardano is an ecosystem that's being built. Not only that, they're coming out with the Alonzo project, which is smart contracts, which I believe will rival Ethereum and start to steal market share from Ethereum. Now, I'm really going to go into a nerd bag here, so please bear with me. Ethereum is doing something that Cardano already has, which is they are trying to move from proof of work to proof of stake. Currently, Cardano works on the proof of stake model, right? Ethereum is trying to do that currently, which is why if you go to Coinbase, you see there's 2 Ethereums. They did a hard fork because they're trying to move from proof of work to proof of stake. When you have proof of work, which is what Ethereum and Bitcoin work on, you basically have these miners that mine or fix problems on the blockchain and get rewarded for it, right? So question is, people like me and yourself, we don't have access to these millionaire miners. Big companies like Marathon, Patent Group, Riot, Marathon Digital Holdings, Riot Blockchain, and other big conglomerates in China, they have most of the miners in the world and they get rewarded most of that Bitcoin, right? So they have a conglomerate or monopoly over the proof of work model. Well, the proof of stake model actually gives rewards to people who actually own and stake their crypto. All right, so that is great because it gives the average Joe access to get rewarded. And also it gives you that yield and appreciation, which is what I was talking about, which is what you want from any asset you're going to own. Again, right, it's going to take Ethereum a few years to move to that proof of stake model. Cardano already has it, and they're coming out with smart contracts. That is going to rival Ethereum and allow Cardano to steal market share, which is why I'm very bullish on Cardano. So I was very biased just now, by the way. But I also told you guys how blockchain works and how you can think about them.
No, that's super interesting. Yeah, as we know, sort of when it's with Bitcoin and Ethereum, it just takes more and more computing power, and that's that there's been a lot of people talking about the electricity.
And Elon Musk has come out. He's been a big proponent of that, right? If you guys saw the thing with him, Jack, and Kathy, that was a big thing that they talked about was the energy that it takes to mine Ethereum Bitcoin is more than a country, right? What it takes for Cardano to work is almost like a small city or like an apartment complex, right? So it's more eco-friendly. The transactions are faster on Cardano, and Cardano hasn't had the upward appreciation like altcoins, but also has been moving like a stable coin such as a Bitcoin or Ethereum, which tells you it's not an altcoin like a Doji because it doesn't have these drastic runs in volatility. It actually has had slower, more consistent growth and looks more like a stock if you look at the chart. It doesn't really look like a normal cryptocurrency, and that says a lot. That's because it's peer reviewed, right? So that brings validity and credibility to the blockchain and the projects they're doing. And that's why I'm so bullish on it, because I'm really big on credibility, right? And being able to research. You always hear me saying referencing back to prove it. Research, that is what determines how I invest, because I don't want my emotions to dictate it, because so my emotions are typically wrong when it comes to investing. The numbers don't lie.
Yeah, definitely. I think that's an awesome way to look at it. So are there sort of any other altcoins that you're watching personally, or is it mainly
on you? I'm gonna be honest with you. I only have investments in Bitcoin, Ethereum, Cardano. Those are the only 3 in which I have my money, because I can build a thesis around why I should be investing in them and what my projections can look like depending on their forms of innovation. So those are the only 3 cryptos I personally am invested in. And you'll be surprised, a lot of the other cryptos are actually tokens, which means they're built on top of the other crypto platforms. Like, for example, Tron is built on top of Ethereum. So if you own Ethereum, you get the appreciation of Tron too, right? Yeah, you can get Tron at a cheaper value, but it's built on top of Ethereum. So whatever Ethereum does, Tron's gonna do as well. So I just prefer to hold Ethereum. I prefer to hold the source, not the branches. I want the seed, not the branches.
Yeah, awesome. That's a really good way to look at it. Now, something you mentioned there, which is quite interesting, was the thesis. So like building a narrative, it's almost building a narrative, getting the fundamentals and the technical analysis to why you're buying this. And then from there, investing, rather than, some people just get, FOMO'd into it, or they just buy it because they say the price is going up, but actually put the work in beforehand.
Yeah, building a thesis is important. when I consult people, I find that a lot of people are just investing off of news and what they heard someone say, or someone else's emotion. And I don't think that's the best way to distribute your hard-earned money. I think we all work hard for the money which we earn. And I think it deserves that proper attention and care, which is why I tell people, if you are not willing to invest in your intellectual property on how to invest, your overall investments are going to be horrible. They're not going to be good because you didn't take the first correct initial investment, which is in knowing. So I find it funny that people often want to invest, but don't want to invest in learning. It's like, huh? That doesn't make any sense.
Yeah, I agree. It's like, if you want to do that, just buy the S&P 500 and watch it go up.
Yeah, just buy an index. If you're gonna just keep it simple, buy an index. Or if you're not gonna do that, just go to a casino because your odds are pretty much the same.
Yeah, no, I think that's a great way to look at it. So, David, thank you so much for joining the podcast today. I do have one more question. So, sort of, what is one message you'd want listeners to take away from our conversation?
One message I would like the listeners to take away is that there is no poverty, there's only abundance. It's all a state of mind. There's no poverty, only abundance. So I challenge everyone to seek larger expression, whatever you're doing. If you can outgrow the place you're in, everything else around you will grow.
That's interesting. Even though it was my last question, that's like a new point. So poverty over abundance. Can you explain that more? So you're saying if people are, I guess it's the same thing. There's no pride in poverty. It's trying to grow as much as you can and trying to.
Yeah. There is no poverty. There is no poverty. There's only abundance. Like literally, I told you, if you find yourself in a state of poverty, you're just not asking for enough.
Yeah.
Right. I think that we've been told a lie. I think we've been told that there's a limited supply. I actually believe the opposite. I believe there's an infinite supply. So if there's an infinite supply, well, then that means opportunities are limitless. Then if opportunities are limitless and I don't see myself getting much opportunities, that means that you're thinking in a supply of being limited. If you think of supply of opportunities being limitless, you will find yourself where you want to be, which is why I say there is no poverty, there's only abundance.
Awesome, man. Yeah, as I said before, thank you so much for joining the podcast. If anyone wanted to get in contact with you or learn more about what you do, what would be the best place to do that?
Oh yeah, you can look me up on LinkedIn, on Instagram or Facebook under David M. Torrence. And you can look up my nonprofit KP Cares under KP Cares Foundation on Instagram or Facebook.
Perfect. Awesome. I'll put it all down in the description. But yeah, thanks again. I really appreciate it.
Thank you for having me on. I appreciate it. Much love.
No problem. Cheers.